Welcome to the debate. Today, we're diving deep into the really intricate world of crypto tokenomics. We're specifically focusing on how we evaluate the long-term investment potential and, the inherent risks of crypto tokens that aren't NFTs or meme coins. We're pulling insights from, the latest industry reports and some foundational research to bring you pretty comprehensive discussion.
And the central question we're wrestling with today is really this. What constitutes the most robust framework for evaluating these specific tokens, the non-NFT, non-meme ones, for long-term potential and risk? How do we best balance, those traditional quantitative models with the really unique qualitative aspects of decentralized ecosystem design?
Right. My perspective leans pretty heavily on adapting established quantitative valuation models from traditional finance. I believe their predictive power and their reliance on solid empirical data are just paramount in minimizing subjective bias, especially for long-term investment decisions.
And I come at it from a different angle. While quantitative models certainly offer valuable insights, I'm convinced that the unique, decentralized nature of these crypto economies necessitates a primary focus on qualitative factors. Things like robust token utility, genuinely balanced distribution, and effective governance. Those, to me, are the real drivers for long-term sustainability and, frankly, risk mitigation.
Absolutely. So my position is that the most reliable framework, really for assessing crypto token value and risk, lies in the rigorous adaptation and application of these proven quantitative valuation models. These are the tools that have historically offered structured, data-driven approaches in finance. Let's consider the equation of exchange, MV equals PQ. For utility tokens, this is crucial. It helps us understand how the amount of money in circulation, M, times how fast it moves, V, equals the total value of transactions, P for price, Q for quantity. Buterin and Pfeffer have really emphasized how token velocity and the time users actually hold a token directly impact its value. We've seen empirical data from Coinmetrics showing Bitcoin's velocity actually decreasing as its price increased, which is a trend that aligns with this model, and Ethereum's velocity also offers some fascinating insights. A practical application here is the concept of token sinks, mechanisms like, say, transaction fee burning. These are quantifiable design choices, deliberately put in place to manage velocity and ensure value accrual within an ecosystem. Then we have discounted future utility models. These draw direct inspiration from traditional finance's discounted cash flow, or DCF, analysis, offering a really powerful predictive lens. Pioneers like Berniske and Winton have advanced these models, incorporating crucial factors such as token supply, projected market size, adoption curves, and of course, appropriate discount rates. For instance, BlockApp's analysis estimated Ethereum's first-year cash flows via DCF at roughly $1.9 billion, with projections stretching out 20 years. And let's not forget price regression models. We've seen some incredible predictive power here, like Trello's logarithmic regression that pinpointed Bitcoin's $10,000 price with, frankly, remarkable accuracy, or Plan B's stock-to-flow model, which forecast BTC at $55,000 after the May 2020 halving, directly linking value to scarcity. By focusing on these objective metrics and models, investors can perform really insightful side-by-side comparisons of major assets like BTC, ETH, XRP, BNB, and SOL. They can even identify potentially undervalued projects like CoinGape's 2025 report suggests for Algorand, Chainlink, and Cosmos. And platforms like CoinGecko Research and Coinmetrics Network Data Pro are invaluable for providing the granular data needed for this level of analysis, letting you compare pretty much any of the top 100 non-NFT, non-meme coins you might be interested in.
Okay, you've laid out a very, very compelling case for the power of quantitative analysis, and I absolutely agree. It's a piece of the puzzle. It's essential. But, and this is really where I diverge, I find that a purely quantitative approach, no matter how sophisticated it gets, often overlooks the fundamental drivers of value and sustainability that are truly unique to decentralized token economies. The long-term success and the risk profile of a crypto token, in my view, are intrinsically tied to its qualitative design. Token utility and use cases are, in my mind, paramount. As Yellow Capital has highlighted, a token needs a clear, compelling reason for holders to keep it beyond just, mere speculation. Take Chainlink's Link token, for example. It's not just some tradable asset. It's literally the lifeblood of its Oracle network, absolutely essential for data verification and enabling smart contract services. Now, that creates an intrinsic demand that no simple price chart can fully capture. Tokens have to serve a purpose, whether it's for payments, as a utility, or for governance, to possess lasting value, a point Pixelplex has elaborated on quite extensively. Equally critical is a balanced token distribution model. Yellow Capital gives a stark warning here: poor distribution, especially where, a small group of early investors controls a disproportionately large chunk, can effectively tank a project before it even gets off the ground, just due to immediate price volatility and, frankly, the concentration of power. When we look at initial token distributions, we see a whole wide spectrum. Ethereum, for instance, allocated about 83.47% to investors and 16.53% to founders, whereas Solana distributed 38% via airdrops or rewards, 37% to investors, and 25% to founders. What's interesting now is how newer projects are increasingly leveraging airdrops to try and decentralize distribution right from the outset, aiming to foster a stronger community. Lastly, and look, this is non-negotiable for sustainable growth, we need effective governance and incentive structures. Block Apps emphasizes the need for clear governance frameworks, balanced distribution, and robust incentive mechanisms. Decentralized autonomous organizations, or DAOs, with their various voting mechanisms, whether they are token-weighted, quadratic, or proposal-based, represent a crucial evolution in governance. They promote transparency and aim to align stakeholder incentives, as both Block Apps and Yellow Capital explain. For a deeper dive, the decentralized token economy theory, DTEC framework, detailed in Archive, provides a pretty sophisticated agent-based dynamical system. It models wealth distribution, performs stability analysis, and helps identify systematic weaknesses in token economies, using metrics like the Gini coefficient to assess wealth inequality and the Nakamoto index to measure decentralization. And resources like Token Unlocks and Arkham Intelligence are excellent for providing further insights into these qualitative factors, including crucial things like vesting schedules and staking incentives.
That's a powerful argument for looking beyond just the numbers. I'll grant you that. However, let's turn our attention to the primacy of empirical market data versus what you're describing as sort of inherent ecosystem design. My contention is that while underlying design is important, sure, what we observe in the market, the quantifiable data, often gives us the clearest signals of stability and potential. I mean, recent empirical data from CoinGecko's Q2 2025 crypto industry report clearly demonstrates a significant rebound across most crypto sectors. Top cryptocurrencies like ETH saw, a 36.4% gain, BTC a 29.8% gain, and SOL a 24.1% gain. We also saw the correlation between the total crypto market cap and the S&P 500 increased to 0.88, indicating a much tighter alignment with broader macroeconomic forces. This observable, quantifiable market behavior, readily available on platforms like, the Coinbase app and CoinGecko Research, allows for objective side-by-side comparisons of assets like XRP and BNB. It truly underscores that robust quantitative models can indeed capture market trends and help identify investment potential, as evidenced by the actual performance of these top tokens. Doesn't this objective, real-world performance, even in a volatile market, give us a more reliable indicator of stability than purely theoretical design principles?
I understand why those market rebounds and correlations feel like compelling indicators. They certainly show short-term market sentiment and, that macro alignment. But my concern is that they primarily reflect just that sentiment and short-term trends, rather than the underlying structural health and, the long-term viability of a project. The source material from Yellow Capital explicitly warns that deep-seated issues like poor token distribution can literally tank a project before it even starts, completely irrespective of whether the broader market is bullish or bearish.
Right. Similarly, uncontrolled token inflation, often a byproduct of unsustainable staking rewards, consistently leads to rapid dilution and price collapse. These to me are fundamental design flaws, not mere market fluctuations that a rising tide lifts, right?
The DETECT framework I mentioned earlier directly addresses these by enabling the simulation of wealth distribution dynamics and stability analysis. It actually treats policies like transaction fees and money supply as control variables, showing how to achieve desired outcomes rather than just observing what happens after the fact. Relying solely on price data, even strong upward trends, truly overlooks these critical, deeper systemic risks that only a thorough qualitative analysis can really expose. How do your quantitative models, for example, truly account for, say, a sudden massive sell-off from early concentrated token holders, or a project's inability to adapt its governance structure to community needs down the line?
Those are valid concerns, absolutely. And the impact of concentrated holdings is certainly a risk factor. However, let's dive into the role of token velocity and utility in driving fundamental value. My argument is that the velocity problem is a very well-documented, quantifiable challenge for utility tokens, as articulated by Buterin and Pfeiffer. If users acquire a token, use it to access a service, and then immediately sell it, which happens a lot, the token's value can converge to a very low level because that demand isn't translating into holding. This is a direct, measurable economic pressure. The empirically supported solution often lies in integrating things like token sinks or burning mechanisms to reduce circulating supply and staking models to increase holding time. We saw Bitcoin's adjusted velocity decrease as its price rose, remember? And Samani's work on burning and staking models directly addresses how these mechanisms can support value.
For example, a project's tokenomics must integrate these quantifiable controls to ensure value accrual and effectively combat inflationary pressures. And tools like token unlocks are fantastic for tracking these schedules. So while utility drives demand, isn't it the quantifiable design of how that utility interacts with supply and velocity that truly determines long-term value capture?
That's a compelling point about velocity, yeah. And the need for mechanisms like token sinks, I won't argue that. But have you considered that fundamental, robust utility is what actually drives initial and sustained demand, and in turn organically mitigates the velocity problem in the long run? Link, Chainlink's token, as Yellow Capital notes, isn't just a speculative asset. It's the lifeblood of its Oracle network, indispensable for data verification and smart contract services. This deep embedding within a critical piece of infrastructure provides a clear, undeniable reason for holding, fostering genuine long-term demand beyond pure speculation. Consider projects highlighted as potentially undervalued, like Algorand, Algo, which offers, 10,000 transactions per second for DeFi applications? Or Hedera, HBAR, for its enterprise-grade solutions backed by major players like Google and IBM. Or the Graph, GRT, powering data querying across over 90 chains, as detailed by CoinGate. Their intrinsic utility creates real-world value and leads to adoption and ecosystem growth. This is a qualitative assessment of purpose that, frankly, no velocity metric alone can fully capture. Understanding why a token is held for the long term is just as crucial, if not more so, than merely measuring how long it's held. It's really about the depth of integration, not just the speed of the transaction.
I appreciate the emphasis on intrinsic utility. I really do. But my argument for long-term sustainability often points back to the sheer power of scarcity. Plan B's stock-to-flow model, which rigorously tests for co-integration between Bitcoin's market value and its scarcity, the inverse of its annualized supply issuance, predicted a BTC price of $55,000 after the May 2020 halving. I mean, that showcased remarkable accuracy. According to Coinmetrics, a hard-capped maximum supply, like Bitcoin's 21 million coins, provides a transparent and, crucially, unalterable basis for value against inflationary pressures. This makes it an incredibly compelling store of value, particularly in uncertain economic climates. This predictable, hard-coded scarcity offers a clear and strong investment thesis.
Then a dynamically adapting system, which by its very nature introduces more variables and potential points of failure?
Well, while scarcity is undoubtedly a powerful attribute, and Bitcoin's success certainly highlights its appeal, relying solely on a static token supply can be, I think, insufficient for true long-term sustainability in our rapidly evolving technological and economic landscape. I come at it from a different perspective. True long-term sustainability, as BlockApps outlines, really stems from clear governance frameworks, a balanced token distribution, and effective incentive mechanisms, coupled with a commitment to regular documentation updates. The DTEC framework, for instance, precisely emphasizes the ability to control economic mechanisms through policies on money supply, transaction fees, and various restrictions to achieve desired wealth distribution dynamics and adapt to changing conditions. Look at stablecoins like USDT. Despite having an unlimited maximum supply, they maintain significant market cap and utility through robust cross-platform accessibility and sophisticated pegging mechanisms, as Pixelplex shows. This demonstrates that dynamic, adaptive governance, often facilitated by DAOs and platforms like the Mercata marketplace, is actually crucial for resilience and sustained relevance. It allows projects to evolve with market demands, community needs, and technological advancements, a flexibility a purely static scarcity model simply cannot offer, can it?
This has been an incredibly insightful exchange, hasn't it? It really highlights the profound complexity inherent in evaluating these non-NFT, non-meme crypto tokens. My case has been about the foundational role of quantitative valuation models, drawing on their empirical predictive power and historical success in traditional finance, while acknowledging their necessary adaptation for the crypto space, through metrics like token velocity, token sinks, and stock-to-flow models. For anyone looking to compare tokens, the data from sources like CoinGecko's Q2 2025 Crypto Industry Report and Coinmetrics Network Data Pro offers immense value.
And I've argued, hopefully persuasively, that the decentralized and ecosystem-driven nature of crypto demands a deeper, perhaps primary focus on qualitative aspects. Factors like intrinsic token utility, fair distribution, and truly adaptive governance structures are, to me, the critical levers for long-term sustainability. Frameworks like Detect, alongside the insights from resources like Yellow Capital and BlockApps, help us model and optimize these crucial design elements, giving us a more holistic view of the token economy. These are the tools for uncovering the deeper risks and perhaps the true potential for projects like Algorand, Hedera, or the Graph.
Ultimately, it really appears that a truly robust framework for assessing investment potential and risk in crypto tokenomics has to incorporate both rigorous quantitative analysis, leveraging resources like CoinGecko's extensive data and Coinmetrics valuation primers, and a sophisticated qualitative understanding of a project's economic design and community dynamics, which platforms like BlockOps and Yellow Capital help address. The most informed decisions will likely emerge from an integrated approach, one that acknowledges the strengths and limitations of both perspectives. It really leaves the individual investor to determine the optimal balance for their own analysis of, any of the top 100 non-NFT, non-meme coins out there.
Indeed. The journey to fully understand and effectively evaluate these evolving digital economies is very much ongoing. It invites continuous exploration and, of course, continued debate.